Welcome to The Explainer. Today, we are diving into a really huge shift that's happening right now in one of Asia's most dynamic economies. Seriously, this is a change that's set to redefine its entire financial future.
Okay, let's get right into it. For the first time in 10 years, Vietnam is completely overhauling its banking rules. And look, this isn't just some small tweak. It's a massive development, and it's all designed to make the whole financial system stronger and, get it in sync with the rest of the world.
So what does this level up actually mean? Well, it's a fundamental change in how banks are going to operate, how they handle risk, and most importantly, how they protect the whole economy from any future financial shocks.
To really understand what's going on, you first need to know about something called Basel III. Just think of it as the international rulebook for safe banking. It's basically the gold standard that was created after the 2008 financial crisis, and now Vietnam is moving to adopt its core ideas.
So, the official name for this new operating system is Circular 14. This is the new rule book, and it's replacing an older set of rules, which was called Circular 41, that's been around for almost a decade. And this is where it gets really interesting. You can see the evolution laid out so clearly here. We're jumping from the older Basel II standard to a framework that's much, much closer to Basel III. And instead of just one standard way to measure risk, now banks can build their own sophisticated models. But the big one? We're going from just a basic safety net to one with extra crucial buffers. Let's talk about that safety net first, because it's a huge deal. The old system had one, sure, but these new rules are adding multiple layers of protection. You can literally think of them like financial airbags and crumple zones for the banking system. They're there to absorb the impact if a crisis hits.
So under the old system, every single bank had to hold capital that was equal to at least 8% of its assets. Pretty straightforward.
But, and this is the key, Circular 14 adds a brand new layer, a mandatory capital conservation buffer of another 2.5%.
So when you do the math, the real minimum capital level for most banks is now 10.5%. That's a huge jump, and it makes the entire system way more resilient than it was before.
Okay, but this whole upgrade isn't just about making banks hold more cash. It's about making them fundamentally smarter about how they look at and manage risk in the first place. Which, of course, brings up a great question. What does a smarter bank actually look like? I mean, how do you measure risk more intelligently?
Well, the answer is you move away from a one-size-fits-all approach. The new rules allow the more sophisticated banks to build their own custom risk models. It's a method known as the internal ratings-based approach, or just IRB for short.
This whole IRB approach is really built on three core pillars. The first one is PD, which stands for probability of default. It's a model that asks a very simple but powerful question. What are the precise odds that this specific borrower is not going to be able to pay back their loan?
Okay, so that's piece number one. The second pillar is LGD, or loss given default. This takes it a step further and asks, all right, if they do default, how much money are we actually going to lose?
And the final piece of the puzzle is EAD, or exposure at default. This one calculates the total amount of money the bank has on the line at the exact moment a borrower defaults. So when you put all three of those, PD, LGD, and EAD together, you get this incredibly precise picture of risk. But look, building these things requires some serious expertise in data science, statistics, you name it. It's so specialized that it's actually created a whole industry of expert courses just to train banking pros on how to do it right.
Okay, so that's the theory. But how does this all translate into the real world? Because when banks can measure risk more accurately, it actually changes their behavior, and that has a direct impact on the entire economy.
And this is where it gets really cool. Just look at this. Under the old rules, a loan to, say, a farm was seen as pretty risky. But the new rules recognize it's actually safer, so they've cut its risk weight in half. This makes it cheaper for banks to lend to these absolutely vital sectors, like agriculture, small businesses, and social housing. And on the flip side, it makes it more expensive to hold on to riskier, overdue loans. It's a really clear signal.
So, let's zoom out. What's the big picture here? What are the key things that you should really take away from all this?
Well, first,
you get a much safer and more stable financial system for everybody. Second, by getting in line with global standards like Basel III, it makes Vietnam a much more attractive and transparent place for international investment. Third, like we just saw, it cleverly nudges banks to lend to key parts of the economy. And finally, for investors, it opens up new themes around identifying the banks that are best prepared for this new world.
Now, a massive change like this isn't just going to happen overnight. The rules officially kick in late 2025, but the government's given banks a really long runway, all the way to the start of 2030, to fully get on board, build their models, and raise the capital they need. It's a very careful, deliberate transition, a marathon, not a sprint.
This banking upgrade really is a huge leap forward. It's bringing Vietnam's financial plumbing into the modern age. And that leaves us with one final, big question to think about. With the banking system now on this clear path to modernization, what other critical sector of the economy is going to be next?